Take this in. More than 150 public companies now hold close to 1 million Bitcoin. That's between 5 and 7% of the entire supply, depending on how you calculate lost coins. At the same time, exchanges are down to less than 15% of circulating Bitcoin in their reserves. Imagine playing musical chairs, but half the seats are already locked away by corporations before the game even starts. That's the market we're in right now. Scarcity is no longer just a talking point. It's the structural reality driving Bitcoin's next bull case. Bitcoin began as a grassroots experiment, a cypherpunk dream. For the first decade, it was retail traders, early adopters, miners, and a few adventurous hedge funds. Then, everything changed in 2020. Michael Saylor and MicroStrategy made the boldest move. Facing inflation, near-zero interest rates, and a pile of idle cash, they turned to Bitcoin. And not just a small buy, billions. At the time, commentators called it reckless. Analysts said it was a gimmick. But when Bitcoin doubled and then doubled again, suddenly that reckless decision looked visionary. Tesla followed. Square, now Block, followed. Smaller firms tested the waters, and the story flipped almost overnight. It wasn't, is Bitcoin too risky for companies anymore? It became, is it too risky not to? Because holding Bitcoin isn't just about balance sheets. It's about narrative. A company that says, we hold Bitcoin, signals innovation, risk-taking, alignment with a younger generation of investors. It's a story they can tell shareholders. And in capital markets, narratives move money. Now, let's pause on the numbers. Over 988,000 Bitcoin are in corporate hands today. That's worth more than $100 billion. MicroStrategy alone holds over 630,000 Bitcoin after adding another 3,000 coins in August. The United States government holds nearly 200,000 Bitcoins from seizures. And exchanges? Their reserves have fallen to levels not seen since 2018, under 15% of circulating supply. Think about what that means. Less than 1 in 7 Bitcoin are available on major exchanges. The rest is locked up, stored in treasuries, or lost forever. That's why a modest inflow into an ETF or a big corporate buy can move the price by $2,000 or $3,000 in a single day. The order books are too thin. Scarcity is no longer abstract. It's mechanical. Picture an ocean slowly being drained. Years ago, traders could swim freely. Liquidity was everywhere. But now, corporate treasuries have lowered the waterline. Whales and institutions dominate the deep end, and retail traders are splashing around in the shallows. That's why a single whale selling $2 billion worth of Bitcoin can trigger cascading liquidations and wipe out $900 million in hours. There's no cushion. Every big move slices deeper. It's brutal in the short term, but long term, it's bullish. Every coin locked in a treasury is one less coin for the market to chew on. Every wipeout of leverage doesn't touch those holdings. The structural bid underpins Bitcoin in ways retail never could. So why are companies doing this? The reasons are simple. First, it's an inflation hedge. Companies don't like watching cash rot on their balance sheets. Bitcoin offers asymmetric upside. Second, it's a shareholder signal. Younger investors see Bitcoin as innovative, and companies want to attract that capital. Third, it's competitive. No CEO wants to be the one left holding nothing while rivals market themselves as crypto forward. And fourth, it's narrative. Just as oil once symbolized industrial power and gold symbolized monetary stability, Bitcoin now symbolizes digital strength. It's not just MicroStrategy anymore. Insurance companies are buying, payment processors are buying, media companies are structuring entire plays around crypto. The corporate playbook is spreading. Now, before we go further, a quick reminder. If you're holding Bitcoin or thinking about it, security matters. We've seen exchanges collapse, wallets hacked, and billions lost. That's why we recommend a Ledger hardware wallet. Keep your coins safe before central bank digital currencies and regulation change the landscape. You'll find the link in the description. Alright, let's come back to the risks. Because nothing is free. Concentration is the first risk. If a handful of companies own such a huge share of Bitcoin, they can distort markets. Imagine MicroStrategy dumping 500,000 coins. The market would crater. It's unlikely, but possible. Regulatory risk is next. Governments could change accounting rules, tax frameworks, or reporting standards to make Bitcoin less attractive. And political risk is lurking too. If states start treating Bitcoin like oil or gold, as a strategic commodity to be controlled, it could undermine the very decentralization ethos that drew people in. But let's zoom out, because corporations aren't the only ones holding. Governments are in the game. The United States has close to 200,000 Bitcoin seized from criminal cases. El Salvador made it legal tender. Other nations are eyeing strategic reserves. Once states start playing, it's no longer just companies signaling innovation. It's entire countries. And when governments hold, corporations double down. Because no CEO wants to look less forward-thinking than the state itself. So where does this go? If companies already hold 1 million Bitcoin, what happens when it becomes 2 million? Or 3? At this pace, we could hit those numbers in under a decade. That would mean 15 to 20% of supply locked away in treasuries and ETFs. At that point, Bitcoin stops being a retail trader's playground. It becomes something bigger, a global reserve, digital corporate gold. For traders, that means volatility won't disappear. Thin order books cut both ways. When ETF inflows arrive, price rockets. When whales sell, price crashes. But for investors, the trajectory is clear. Scarcity plus institutional demand is a recipe we've seen before. Gold in the 1970s after the US decoupled from the dollar. Silver in the Hunt brothers squeeze. Bitcoin is running its own version of that playbook, only faster, because it's global and digital. And here's the part that matters most to you. You don't need to be a whale or a CEO to benefit. Scarcity doesn't discriminate. Whether you hold 0.01 Bitcoin or 10 Bitcoin, the same supply crunch is in your favor. Corporations are effectively doing the heavy lifting for you, locking away supply and raising the floor under the asset. Yes, volatility is scary. But volatility is the price of admission for asymmetric upside. The companies buying Bitcoin aren't afraid of drawdowns. They're betting on a decade-long squeeze that favors the patient. That's the signal. So here's the bottom line. Over 150 companies, nearly 1 million Bitcoin, less than 15% left on exchanges. Scarcity is no longer theory. It's here. Corporate treasuries are quietly reshaping Bitcoin's destiny. Now it's your turn. Is this the beginning of the ultimate supply squeeze that sends Bitcoin to new heights? Or is it a dangerous concentration of power in the hands of too few companies? Drop your thoughts in the comments, smash like, follow for tomorrow's update, and remember, we will see you at the top.